Welcome back. Here with us on Trading Hour. Let's get some market perspective with George Thomas, who's from Quantum AMC. George, thank you very much for joining in. Season's greetings to you. Hope you had a great Christmas break and are all set to wind down the year. So, just tell us top down, what is the overall portfolio thesis with which you're entering 2025? Because there are a lot of moving parts. The market's been consolidating. There are concerns about urban consumption. And it remains to be seen whether CapEx can still be a market-leading sector next year. Your views?
Thanks, Surabhi. Season greeting to you and all the viewers at CNBC. Clearly getting into 2025. So 2024, we have seen some bit of earnings moderation. One, after COVID, there has been a margin expansion, primarily driven by a lot of raw material input cost moderation, and that kind of created a very high base for a few quarters in the last year from an earnings growth perspective. So going into next year, that would moderate to some extent. And the second major slowdown which happened was on the capex front. Government capex, which was taking the lead, had taken a backseat with elections and all those approval machinery kind of slowing down. So even that could kind of reverse in the current year. But of course, we would be watchful of on the quality of revenue expenditure which are done by different governments. And that remains a key watch point. But our sense is that government capex should come back this year, and that should give some fill up to the economic growth to some extent. But as far as otherwise, from a broader perspective, there are no clear headwinds other than that. But obviously, some of the sectors like industrials, which would be major beneficiaries of capex revival, those have already priced in a fairly strong earnings growth. So we may not be able to play those themes to a large extent. And another thing which has happened over the last year is the small and mid-cap segment, which was already expensive, again has rallied on a relative basis on a phenomenally good manner to close to 30%. So that has kind of resulted in a more overvaluation in those pockets. So our sense is large caps could lead in 2024, and within large caps, the obvious value bet remains private sector banks. So apart from that, some pockets of opportunities are emerging in insurance space or some regional cement players where we see the upside could be fairly decent.
Understood that, George. So you spoke about private banks, you spoke about regional cement players. Now, talking about H2, what is the kind of earnings recovery that you're penciling in? And FY26, given the slightly subdued base, we will be entering, on the back of a low earnings in FY25. What is it that you're penciling in? And apart from private banks and cement, what is it that you like?
See, the second half would be a gradual earnings recovery because some of those headwinds which has hit the economy in terms of urban consumption or government capex, the revival would be slightly slower. So we don't expect a sharp uptick in any of those metrics. So second half would be a slow recovery. But FY25 earnings growth, we don't feel it would be anything different than what we have seen in the longer term history. So the kind of earnings growth which we see, which is in line with nominal GDP growth of 12-13%, we don't feel FY26 would be any different. We don't feel there would be a marginal deceleration to that extent.
Okay. So, George, top investment ideas, 2025, what would you go with?
See, 2025, clearly banks was one sector which was left out on a relative pecking order if you were to look at the sectoral returns. The other sector which had a fairly muted return was FMCG. But our sense is there has been a lot of valuation excesses built in that sector over the years. Because for a large part of the last decade, those were the only names where there was some earnings growth when the whole of the market lacked material earnings growth. And that has built in some bit of overvaluation there. But our sense is over the course of the year, there could be a case that some of even the FMCG names could get to those fair values on, and investors could hope for building in positions there. But banks is one clear sector where there is reasonably good value, and it has not performed well in the last couple of years. So as the credit cycle normalizes, as those credit costs normalizes, we would clearly see some of those private sector banks, which has fairly strong franchises along with good underwriting practices, to lead the market.
Right. Thank you so much for joining us, George. Wish you and your team a very happy new year. Well, time now for a short break. We'll get you more on the markets on the other side.